Morgan Stanley beat expectations. Stock is up 8%. Good news, right? What say you, Anthony Curry of Reuters Breaking Views?
You can never say that an 8% rise isn't great. I think what investors are looking at here is the promise. And that's where you've got to be a little bit wary, because they've had several promises like this before from Morgan Stanley. But the good thing from the fourth quarter, I think, is you've got a 17% pre-tax margin on the Global Wealth Management unit, which is far more than they've had. They're normally around 10, 12%. And that's because they're finally getting a good benefit from owning a bit more of what the joint venture they have with Citi. And also the costs have come down from having to integrate the whole thing. So that looks good. Right. They may well get a bit more juice this year as they buy more of the thing. But look at their returns. They're pretty bad. If you strip out all of the one-offs and allow for the fact their tax rate was just 11%, and you put it on a high one, say 28%, 30%, they've got a return on equity of under 5%, which is dismal. And their efficiency ratio is awful. They spent 85% of their costs last year, of their revenue last year, on costs after adjusting for some of these one-offs. So it ain't looking good, but it is getting better. But like I said, Gorman's been there for 3 years, done a lot of restructuring, and I think if he cannot get that return up to about 10% this year, then he should probably go.
All right, so Morgan's the last of the big banks to report. Obviously, we heard from JP Morgan and Goldman. Strong earnings there, but compensation the issue. Jamie Dimon, obviously bonus cut, percentages of compensation cut at Goldman. Yesterday, you were here to talk about B of A and Citi. Kind of a mess over there, charges galore. Looking ahead for 2013, what do you think?
Well, a couple of things. A lot of them are going to be cutting costs more. I mean, B of A and Citi, certainly. Morgan Stanley again. I think Goldman's going to do more as well. And that will help bring down, as the efficiency ratio improves, earnings should improve. And that's certainly for the commercial banks, that's an important thing to do, because a lot of what they rely on is net interest income, and with rates so low, it's hard to get.
Unless squeezed,
unless you're a bank like US Bancorp, which is probably my favourite bank, which it seems really sleepy, but it's got an efficiency ratio of 51%, which is by far the best, and it earns really good returns. And investors just love the stock. It's trading almost at 2 times book value, way ahead of all the others.
And it gets a ringing endorsement from you. That is very tough.
That is very tough to get.
All right, Anthony Curry, thank you so much.
Sure,
I'm going to head now to the hotspot, and we're going to take a quick look at the U.S. stocks there and see everybody's down. And we're going to talk about Intel, which is the big loser today. But before we get to Intel, I'm now joined with Ryan Vlastelica. And Ryan, we're going to talk GE, because good news out of GE. Stocks up 3% today, beat expectations, 7.5% rise in fourth quarter profit.
Absolutely. Beat expectations both the top and bottom line, so strong earnings growth and revenue growth over there, which is encouraging not just for the company but for the economy at large, just because of how big GE is. The only way you can describe it is as a conglomerate. They have really, their nose in every different aspect of the economy. So it's very encouraging there, just from a broader standpoint, to see them, like you said, strong earnings, strong revenue, and an increase in the backlog for equipment orders. So a good sign of demand down the road, and that's why we're seeing the stock up today.
Right. Production in terms of oil and gas and energy, fracking, a big issue there, obviously, as they broaden their equipment in that area. All right, we're going to change some gears here a little bit, and we're going to talk Netflix. Netflix, boy, hanging on, not only hanging on, but doing pretty well. Upgraded by Janney Capital Markets. They're loving this Disney deal a couple weeks back about how you're going to see Disney films after they're in the theaters, not on HBO, not on Showtime, but on Netflix.
Absolutely. Janney's a little bit behind the curve, just considering people loved the deal when it was first announced, but it's still delivering for Netflix right now. They really think it's going to be good for getting new customers, for keeping customers, and so forth. And that's why we're seeing the stock up today. Another important thing, Janney said they didn't see a lot of competition for Netflix right now, at least in the short term, anything that would really sort of pose a threat to their bottom line. So given that Amazon has its own streaming services, Apple, all these other ways for people to get their own media, it's good news for Netflix.
And potentially a Sony deal there, I think, for Netflix as well. All right, let's move on to some bad news. As we mentioned, Intel is down 6% today, the second biggest loser in the S&P 500. Based on the earnings last night, stock's still plummeting.
Absolutely. Stock is down today, and that's weighing on the NASDAQ, the S&P, and the Dow, all of which count Intel as a major component. The thing with Intel, it's not just the earnings, but also their outlook. The outlook might be more important here. And they gave a revenue forecast that was really weak, and a little bit, not as much growth as people were expecting. The revenue fell year over year for this previous quarter, a little bit more than people were expecting there, a bigger drop than people were expecting. In addition, the company came out and said, we have a lot of ideas for capital spending, more than people were really anticipating. And that has some concerns, because people say, there's not a lot of
PC business,
exactly, not a lot of demand for PC. So why are you investing all this money into that? So are they going to have all this capacity but not much demand? Are these investments really going to really pay off? So that's
Get
what
on
people
board
are
better
looking
with
for.
mobile.
Absolutely.
Yeah. All right, let's move on to Apple and a Reuters exclusive here about how Sharp has not quite halted, but almost all but halted production on this 9+ inch screen for the iPad. Now, is this seasonal? Does it mean they're going to the iPad mini? But the stock has been trading. If we had it up there, it was still, it's under that sort of psychological barrier there.
Right.
It seems to be at $500 today.
Well, the iPad mini is doing quite well in terms of sales. A lot of people like it. So it's possible that people are going from the regular size one to the smaller one, which offers a lot of the same capabilities, of course. But this follows Apple's announcement not too long ago just about demand that they were seeing. They were cutting production and so forth. All that stuff was very discouraging. The stock really took a tumble on it. It hasn't really recovered. It's, like you said, it's been under 500, which is almost unheard of for a stock that seems to add $100 every few months.
Yeah.
We don't really know quite what this means yet in terms of what they're seeing in terms of demand, whether it's just the new product cannibalizing the old one. It's something to keep an eye on.
In any case, it comes on the heels of them halting parts for the iPhone 5 as well. So, but we should remind folks, check out our show Techquity later today, because I'm sure there'll be more on Apple and other tech stocks there as well. All right, Ryan, thank you so much. I'm going to move now to the Market Monitor, where I'm joined by colleague Rhonda Schaffler, and you now, from being in Detroit, get to go to sunny Boca Raton, Florida.
Yes, it's an improvement actually in terms of the weather, but there's a big hedge fund conference going on down there. And of course, everyone wants to know what the smart money is doing, right? That's always the key. Even though the hedge fund industry hasn't done that well. The average fund was up about 6% last year, not as good as the market. But what's interesting, Lisa, is we'll be talking to some fund managers outperforming. Small fund managers, we're talking gains 22%, 34%.
Wow.
So we obviously want to hear what they're doing to get it right.
Absolutely. All right, well, watch for that on Reuters Insider. And also, we're going to have you back live, I believe, on the show on Tuesday after the holiday.
Yep, let's know
via
we're here.
satellite or Skype,
However
or however we
we
do
do
these things. Smoke signals, carrier pigeon.
It might be
we'll
that.
see your face somehow. Okay, great. Thanks so much. Remember, everybody, follow us on Twitter at Reuters Insider, and check out our YouTube channel, Reuters.com/ReutersTV. I'm Lisa Bernhardt. This is Reuters.